By May 2014, India's headline economic data showed steady expansion following decades of market liberalization. But those top-line GDP figures obscured severe underlying stress. This animated balance sheet contrasts that rising GDP line with the three structural gaps inherited from the prior era. Growth was expanding the economy without generating formal jobs. Manufacturing's share of GDP was flat, leaving India without the mass employment factory base achieved by East Asian peers. And between 80 and 90, they took office with a direct mandate to resolve these structural logjams. The incoming administration moved away from the arm's-length market opening model of the previous 20 years. In its place, they engineered a highly interventionist strategy that economists have termed state-directed digital capitalism. The state organized its intervention around three distinct pillars: the construction of shared public digital infrastructure, the forced formalization of economic activity, and a nationalist industrial policy reviving domestic manufacturing. This approach diverged sharply from history. The government avoided a return to the direct state ownership of heavy industry seen in the mid-20th century, and it rejected the purely market-led growth model of the 1990s and 2000s. Instead, the state built the platforms. The macroeconomic objective was to pull a vast, untaxed, cash-based population into a newly engineered, digitally monitored formal economy. The foundational layer of this strategy was the JAM Trinity. The acronym stands for Jan Dhan bank accounts, Aadhaar digital identity, and mobile connectivity. Aadhaar provided the anchor. By assigning a unique, biometrically verified digital identity to over 1 billion residents, the state enabled remote, paperless verification for nearly the entire population. The government linked this biometric ID system to an aggressive rollout of zero-balance bank accounts. This integration created a direct conduit for welfare delivery, bypassing intermediaries and eliminating the ghost beneficiary fraud that had drained public subsidies. With identification and banking infrastructure established, the National Payments Corporation of India launched the Unified Payments Interface, or UPI, in 2016. UPI is a real-time retail payments protocol, allowing instant bank-to-bank transfers via mobile phone. Most global payment networks are privately owned and charge merchant discount rates. UPI operates as public digital infrastructure. It is an open, zero-fee protocol designed specifically to prevent private platforms from monopolizing transactions and extracting rent. Because it requires no point-of-sale hardware and charges no fees, UPI rapidly penetrated the cash-dependent informal economy. This dashboard tracks the speed of adoption. Jan Dhan accounts climbed from 0 to over 530 million. UPI volumes spiked from launch to more than 16 billion transactions every month. Within a decade, hundreds of millions of people bypassed traditional banking infrastructure and entered a formal financial grid. Once the digital rails were laid, the government moved to the second pillar, compelling this newly connected population into the formal, tax-paying economy. The primary mechanism was the 2017 Goods and Services Tax, a structural overhaul that replaced a fragmented architecture of state and central levies with a unified national system. This flowchart illustrates the structural leverage of the GST's digital invoice matching architecture. When Firm A sells to Firm B can only claim a valuable input tax credit if Firm A is also registered and compliant. The system creates a self-reinforcing chain where businesses pressure their own suppliers to enter the tax net. The transition caused severe friction. Small and medium enterprises, unfamiliar with digital filing and facing short-term supply chain disruptions, struggled to manage the sudden administrative burden. This followed an even sharper shock. In November 2016, the government executed a sudden demonetization, stripping 86. While these blunt force policies expanded the digital tax base, pushing GST registrations over 14 million, they altered the economy's stability, replacing the steady trajectory of the prior decade with severe turbulence. In March 2020, the COVID-19 pandemic arrived. The government responded with one of the world's most stringent national lockdowns, halting economic activity almost entirely. The lockdown devastated the informal labor market. Urban informal employment collapsed, triggering a reverse migration as workers attempted to return to their rural home states. The result was the sharpest single-year economic contraction in India's history. To engineer a recovery, The state rolled out stimulus packages and accelerated the third pillar of its model, a return to industrial policy designed to reduce import reliance. The primary tool is the Production-Linked Incentive, or PLI, scheme. The government offers direct fiscal payments to private manufacturers, tied precisely to their ability to hit incremental production and investment thresholds in targeted sectors. The PLI scheme capitalized on shifting global supply chains. As major electronics brands moved capacity away from China, India leveraged the incentives to rapidly scale domestic smartphone assembly and export. The combination of digital formalization and targeted manufacturing incentives produced a sharp V-shaped rebound. Real GDP growth surged to roughly 9% in the immediate post-pandemic year, returning India to its position as the fastest-growing major economy. By the mid-2020s, the economy had reached $3.7 trillion, and the India Stack was being promoted globally as a template for digital public infrastructure. Yet the top-line data remains heavily contested. A 2015 revision to GDP calculation methodology has left academic economists arguing that proxy indicators, like electricity consumption and vehicle sales, suggest official figures may overstate the actual rate of growth. A deeper critique focuses on the cost of formalization. Critics point out that the blunt transitions of demonetisation and GST imposed heavy compliance and liquidity burdens on microenterprises. Formalization may not have upgraded small businesses, but simply displaced them, consolidating market share into the hands of large corporate incumbents. This split-screen visualization illustrates the limits of the manufacturing push. On the left, digital metrics and nominal GDP surge upward, but on the right, manufacturing as a share of GDP remains locked roughly between 25% and 28%. Much of the PLI-incentivized activity consists of final assembly rather than developing a deep domestic supply chain. This constraint creates a stubborn labor paradox. While Social Security enrollments increased, labor force surveys indicate a significant portion of the workforce shifted from open unemployment into low-productivity self-employment and unpaid agricultural labor, rather than securing formal factory wages. This state-directed model built financial and digital infrastructure for hundreds of millions of people in a single decade, but the ultimate test, absorbing a massive informal labor force into high-value industry, remains a contested, unfolding experiment.